Hello everyone, and welcome to this video, which I'm recording in response to a comment that was sent to me by one of my Twitter followers who wanted my views on the statement that said the bear market isn't in because the bottom isn't in. And my first response to the statement was, well, yeah, this is correct if it's based on the widely accepted view that a bear market follows a 20% fall from a significant high, or at least a 20% plus fall from a significant high, which occurred in 2022. And if that's the case, then what we're seeing at the moment is a bear market rally from the reversal of October 13th, the low in October the 13th that came in, and the market has been pushing higher since then and pushed even higher since January this year. But, and there's always a but, from a bullish perspective, we could also say that the move lower was simply a correction, admittedly a pretty deep one, from the primary trend that has been in place since March 2020, following the pandemic sell-off when we had the shortest bear market in existence. And what we are seeing now is a move towards a resumption of that primary trend. And to see an example of that, here we have the SPY, the ETF obviously for the S&P 500, where we have the 2020 pandemic sell-off. And this is the trend that I'm referring to. This is the January high where we have 479, where the market sold off. And here we have October. This is dated October the 3rd because this is the monthly chart, but actually the reversal was bang on. It was October the 13th, I think, and it was market wide. Now, you may think it's a bit odd that both views could be valid, but looking at the monthly charts for the indices or their respective ETFs, and I'm actually going to focus on the ETFs, we can actually see this is the case. So for the bears, what are we looking at now? Well, given that we've had this reversal and their viewpoint is that this is a bear market rally, this bear market rally could actually carry on to the all-time high, as we said here, the all-time high of January 2022, which is 479. And if there is a failure, repeated failure at this level, and in doing so, we have the creation of what we call a double top, their view is validated. We haven't seen the bottom of the market yet because it hasn't finished. The bear market rally hasn't completed, as it were. And what we could see at this point, yes, we could see a double top. We could also see maybe the start of maybe a congestion, maybe a distribution phase. But the critical point is it does not carry on higher. For the bulls, on the other hand, what we're seeing at the moment is, since this reversal back in October, and certainly coming into the new year, we have gone past the 20% definition, because that applies equally whether it's a bear market or a bull market. And for validation that the primary trend, if we take this to be the primary trend, as I said, from this significant low back in 2020, a break through the all-time higher, maybe we have a retest of it, but certainly carrying on higher would be the resumption of this primary trend. So yes, you both could be right. It reminds me of that. It reminds me about Schrodinger's cat. That the question. It's a cat that's locked in a box, is it alive or dead? And I believe it's only if you can measure it would you know. And it's a bit like that. This is a bear market or a bull market. Until we can measure what happens when we get to the all-time high, in reality, we won't actually know. Now, it may not get to the all-time high. Something may happen. We don't know. We simply have to keep watching the charts. And this is where the monthly charts are going to be extremely important because of these strong patterns and strong moves that we can see. What we also have to consider in the context of these moves is what sectors were actually driving the market higher at the moment, and what was driving the market lower last year. Because that will then give you another perspective, and in fact, for some of you, maybe a whole new perspective of what we are seeing at the moment. The actual numbers in question: the SPY dropped 28%, and the Qs fell almost 38%. This is this move that we saw between January and October last year. And it's only when we looked at a sector performance table, and the one I'm using here is from a site called Novel Investor, and it's a beautiful table because it also goes back to 2008, and it really gives us an insight of what the markets have been doing since that all important time of the great financial crisis. You have performance of the individual sectors, what was at the top, at the bottom, and the sectors are listed down below. And you also have what the S&P itself, what it was doing with its what it lost or what it gained. 2022, as we have here, as we can see, and the three sectors in question are technology, communication services, and consumer discretionary. Now you will see written and you will hear the market is driven by tech. Tech companies or companies that use tech fall into these three sectors, and they are the biggest companies on the American exchanges. Technology is straightforward. It's the Apples, the Microsofts, etc. Communication services is when we talk about Google, Meta, and in consumer discretionary, we're talking about the Tesla and Amazon. And the figures are here. We've got 28. We've got communication services was actually 39%, and consumer discretionary was 37%. And if we look back to this year, the year to date, what do we have? We have the same three now at the top of the tree, and they've all gone beyond this 20% definition of a market from either a significant low or a significant high. The significant low was October the 13th, and we are well past that year to date. I know markets have pulled back slightly, but the figures are still valid. And the S&P overall is only up 16.9%. But look at what else is here. Very, very poor numbers from the rest of the sectors in the S&P 500. And that brings us to another question, and that is, for which we need an answer, and that is, why is the market being pulled higher by such a narrow number, for a small number of sectors and such a narrow part of the market? And it's actually worse than that when we consider the number of stocks in question. This reversal of fortune, down and then up, has caused the S&P, i.e. the SPY, and the Nasdaq Qs to fall so dramatically. And the principal reason, is the way the indices and subsequently the ETFs are constructed. They use the methodology that takes market capitalization of the constituent companies. So the bigger the company, the bigger the weight it carries in the index and the respective sector. And since the biggest companies all belong in these three sectors, when they reverse, the entire index and the market wobble. This is becoming a real problem because it's distorting what is happening in the market, the perception of what is happening in the market. It's sucking in money flow at a level that a few years ago was no one would believe. And when you have such a concentration of such a narrow group of stock, it can then cause extreme volatility and damage the market overall. Now, I know we don't have volatility, or certainly not extreme volatility at the moment, but it is a problem, if you like, that is bubbling away underneath. You will also come across lots of media analysis on this subject and the dangers it presents. And if you have access to any of these articles, I do suggest that you take some time to understand it, and so that you'll appreciate the danger that it presents. It's a topic all on its own, and maybe something David and I are certainly considering doing another video. If we actually look at the sector weightings themselves, one of the best ways to check these out is to go over at Yahoo. There's plenty of other sites. This is for the SPY, and where we have technology is 28%. But because I said you have to consider the other companies which, if you like, fall under the broad umbrella of tech, with Amazon in the sense that it's not really a strictly tech company, but it uses technology, you also have to add the other sectors that are that correlate, if you like, to technology, and that is the communication services. So you've got almost 9%, and then you've got the consumer cyclicals, the big companies that are in there that are also, if you like, could fall under the umbrella of tech because of their utilization of software, etc. And when you add all those together, you've got 28, you've got 28, you've got 10, that's 38, and then you've got 46. You've got a very large proportion of the index devoted just to three sectors. And just to reiterate, tech, we take as Apple, as Microsoft; communication services, we've got Google, Meta, Netflix; consumer cyclical, as I said, we've got Tesla and Amazon, and other consumer cyclical stocks such as Carnival Cruises. I know it's not strictly tech, but it's cyclical. Discretionary are those companies where they are the first to suffer whenever there is an economic downturn, because it is what it says, discretionary spending. For the Qs, again, I'm using Yahoo here. What do we have? Well, it's no surprise to see tech at 51, but if we look at communication services, there's all important stocks. These are in this sector. That also has a very big percentage. And here it's given us 17.14. And this is what I'm trying to say about having consumer cyclical in an index such as the Nasdaq and the ETF, the Qs. Consumer cyclical is also included here because you can't ignore Amazon and you can't ignore Tesla. And people say, well, why are they in there? For the reasons that I explained earlier. And 10 of the largest stocks represent 60% of this index. You can find all these details, as I said, at Yahoo. There's one other site that you might like if you want to go in a little bit more detail of the actual weightings of the individual companies. And you can see the top 10 in each. And this is a chart. This is a site called Slick Charts. It's a brilliant site. It's completely free. And here we have the Nasdaq 100 companies, and you've got the weightings of, as I said, Microsoft. They're all names that you recognize, but you can see the difference, and it gets even worse because you see Microsoft and Apple, by the sheer weight of their market cap, means that they have a huge holding in this index, and it will be reflected in the ETF as well. And by the time you get to 10, you're down to less than 2%, and this is not an insignificant company. PepsiCo down at 1.696, and you've got the same for the S&P, and there's all sorts of other information that you can find here. So I'm not taking the Dow Jones because that is a price-weighted index. I'm just focusing on the really the SPY and the Qs, and also the Dow's only 30 stocks. It really doesn't reflect what's going on. You could say the S&P and the Nasdaq doesn't, but we are where we are at the moment. When we look at the other indices for a view of how they make up in terms of the sectors. We could also look at the IWM, which is the ETF for the Russell 2000. And when we pull up the monthly chart, what's also interesting about the Russell 2000 and the IWM is this is the speculators index. This is the market for small caps. This is the market where the Apples, the Teslas, the big dogs now would have started. And this is where speculators like to go and see if they can find out what is the next Apple, what is the next Google. So it is a much riskier market. And what it's useful for is it paints a picture of risk sentiment. So if there's a lot of money flow going into the Russell 2000 small cap companies and the IWM, we know the market is bullish, whereas if money is flowing out, sentiment is bearish. May not be a bearish market, but sentiment is bearish. Now, with this chart, this is the monthly chart, what we have here, we have way back, we have the whole of 2021. For the whole of that year, we have really this index going nowhere. So even as the SPY and the Qs were going higher, it really wasn't being reflected in this riskier market. Yes, there was money flow going in. There was a lot of effort going in, as we can see here by the wicks at the bottom of these candles, but it just going sideways. And you could say that it was setting up for a major distribution. And in fact, by the time January came, it followed the other indices and ETFs lower. But what's interesting is there hasn't been the dramatic reversal that we've seen in either the SPY or the Qs. It's now moving sideways once again. It's a fairly wide range. So we can look at this two ways. Are we looking at an accumulation, or is this simply another stepping stone, if you like, a sideways consolidation before we have a further move lower? On the plus side, we have some very strong price support levels here. Volume seems to be sort of holding up, but it's a really good barometer of maybe certainly what the speculative side of the market is thinking, or maybe the speculative side of the market is undecided, because a sideways market has no clear direction, but at some point a trend will develop. But then if we also look at the composition of the sectors, the sector weightings in the IWM, tech is only 15, communication services 2.47, and consumer cyclical is now less than 10%. And by the way, with regard to these percentages for sectors, they change all the time. Even the names sometimes change. So I could say tech is 15% of IWM, which was when I started to prepare my notes. It's now shown as only 9%. The two biggest sectors in the Russell 2000 is actually healthcare, which is 17, and the financials, which is 13. Now, with such a high percentage financials, or relatively high percentage of financials, clearly the banking crisis that we had earlier back in March, that is very clearly reflected in the IWM. One way around this is to look at equal weight version of the indices and the ETFs. And there is certainly an equal weight version for the SPY, which is the RSP. I haven't got the chart up. I will just pull it up for you here. And the reason for including the RSP is it's a little bit of a misnomer, because the price action is pretty much the same based on what the sector, it has a sort of similar sort of sector setup. The difference is it's the stocks are equal weighted. So if you don't have this outperformance by the big market caps, that's why the performance of this ETF and this index is then going to be, if you like, suppressed. But that's just a reason for understanding, really getting to grips with how the indices and how related ETFs are constructed, because it helps to explain the price action from a trading perspective, and also for an investor. If investing, you're just starting out on your investing journey and you think, oh, I'm going to invest in the S&P 500 because it's the 500 top companies in the US. It's obviously, I'm going to be spreading my risk. I'm going to be spreading my money. The fact is you're not. It's just this, it has this highly concentrated focus on just 3 sectors. And within those 3 sectors, you are then talking about 10, I think less than 10 stocks. And this is the downside of having market indices based on market cap. These large companies carry an outsized weight in an index and in an ETF. And as I said, ETF, and that's what I said, it's 10 companies. When they move strongly and they go higher, you could say a rising tide lifts all boats. Some of the returns from these individual companies have been quite spectacular. But when they fall, and if they fall hard, they will take everything else down with them. And just to see some of the results on a year-to-date basis, those of you who have been to any of our webinars will know that David and I really like FinViz. It's one of the screeners that we feature quite heavily in our upcoming stock trading and investing program. First of all, because it's free. It does come littered with ads, but you can get rid of the ads by just giving them an email address. I actually pay for what's called the elite version because I need a little bit more information. But the free version is certainly more than enough to dig out the information that we need on what's happening in stocks and sectors. And this is the year-to-date performance from these companies, where we see Tesla here at 125. We've got Nvidia, the standout star for the whole of the market this year, 193, and we've got Meta at 142%. I mean, these are extraordinary numbers, but there is a downside to this, and the downside is with market cap, they will have such a huge influence on what is happening to, as I said, the index or the ETF. So going back to the 20% definition for a bear market, it applies equally for a bull market. So you could say, given what the S&P has done, and if we go back to the sector charts that we had earlier on our table for the different sectors, these different sectors, it's certainly past that 20%. So are we then back in a bull market? And if I pull up the S&P, the SPY, this is a chart I put up on Twitter. Last month's price action actually took the ETF through the top that we have here that's formed in, if you like, this ascending triangle. We've got higher highs here as we go, as we can see, as the price action moved higher. It was in this sort of pattern, this typical formation of an ascending triangle. And for the bulls, as it were, the goal, the target is this all-time high. This will certainly validate whether there has been a resumption of this primary trend from March 2020. And if it goes through, that will be a confirmation, if you like. So we have an approach to it, but it has to go through the all-time high. To return to the original comment about the bear market bottom, I think this at the moment is just a reversal. The extent of the reversal was technically put it into bear market territory because it was 20% plus. But it wasn't really accompanied by the sort of panic and fear and broad market capitulation that characterizes a bear market. It was driven simply by those three sectors. We will get a bear market at some point, what I call a full-throated bear market, where there really is going to be blood on the streets, as it were. And it may even be sooner rather than later. And what we really have to try and keep in mind is, well, what are likely to be the triggers? And here, there are different categories of triggers or risks. The first category, if you like, is what I've what I would call known unknowns. It's something that's known and it suddenly pops out of the blue, but everybody knows about it. I think it's from Donald Rumsfeld. In other words, these are risks that we're all aware of, the market is aware of. It's a recession, another banking crisis, or it can be a complete unknown. And that's what's called a black swan. And in this category, I should also add, and this is from purely from a personal perspective, and that is what is going on in Ukraine in relation to the nuclear power station and talk that possibly Russia is thinking of bombing it and causing some kind of nuclear disaster, similar to what we had, when there was Chernobyl, although that was an accident. Any of these could cause a major sell-off in equities, and it would really not be a simple reversal or a correction. And this is where we'll have to keep in mind the monthly charts, because it's the patterns that we see on the monthly charts, the price action, what the volume is telling us, the support and resistance level really are going to tell us, is this what we are facing, or the market's going to ignore and it's going to carry on higher. But the answer will be in these charts and what happens on these charts. And just for an example of what happened in the past, I did some sort of historical research, and the period that I wanted to highlight is very much a period that is close to David and I, and it's because it's actually when we kind of started in this business. I want to go back 2000 and the sell-off in 2000. I don't want to look at the chart for the NASDAQ or the Qs. I really want to have a look at the S&P and i.e. the SPY, because it tells us so many things. We have, in a way, a very similar situation that we had last year. We had, as we can see here, we've got a move higher from there was a pullback in 98, then a move higher, not as strong a trend as we had in 2021. But we get to the beginning of 2000, we have an all-time high in March. Then we have a sort of period of a sideways movement. Again, we have wicks to the bottom of these candles. We look as though we've got some weakness coming in here. But it wasn't until August of that year where we had the market attempted to move higher again, didn't take out this March high. And the following month, which was September, and September from a seasonal perspective is actually one of the worst months for market reversals. Everyone thinks it's October because of Black Monday, but it's actually statistically September. So people said, "Oh, well, it's September. It's no surprise to see the market pull back. We've had this nice high. We'll probably just carry on." Well, it didn't. This is what happened. It then moved lower, and we have this trend lower. We know it's a trend lower because we have lower lows and we have lower highs. But what I want you to focus on is the high here was, in fact, this time it's 155. We have this trend lower. The time it took for this bear market to play out, this is 2 years. We're back to October again. So October seems to be quite a good month because it was October last year that we saw a reversal higher. So finally, this came to some kind of pause point, but in the trend lower, we can see the number of times it tried to rally simply from the wicks to the bottom of these candles, and they are very deep wicks. So every time optimistically, oh, this is it, this is the end of the bear market, right, let's go in and buy again, only to be the optimism to be shattered, and we have another try again, and up it goes, and then down. Now, this is what you would expect to see in a typical bear market. Really a lot of optimism on the way down, what looked to be decent rallies, but the bottom isn't in until, if you like, the last buyer sort of throws in the towel, and we have the stopping volume that we have coming in, and we have to have a stabilization of the trend lower, which is what happens. But it's the time that it takes. This was over 2 years. What then happens is we do get this reversal higher, but look at the time that it took, and also notice the candles as they go as we move higher. bull markets take time. The candles, it's a grind. This is always a rush lower. The reversal, and it will happen, takes time and it grinds higher. It took 5 years to regain that 155. And what happened? It goes into October this time of 2007, which was actually the start of the great financial crisis. So, and what it also formed is it formed a double top. So you could say, looking back over here, 7 years, and this is how long these things can take, we suddenly have another top. We've had this euphoria building all the way up to here. Oh, this market is going on onto the moon. But look what happened over here. It didn't manage to get over. And in fact, it was the start of the great financial crisis. Now, are we going to see this happening now? Are we going to get a repeat of this? It is perfectly feasible. What's also interesting, what has happened since those times, is the time these markets take to rise and fall is so much shorter. That's in part due to technology and the sheer number of people that are participating in the market, not just from a retail perspective, but the money that is flowing into the markets there's no comparison to what used to happen back in, as I said, 98, 2000. And it's a good thing. Markets are meant to be democratic. The more participation, the better. But what we want all the time, well, certainly as David and I want to do, and the reason for the books and the programs that we do, and the webinars and the knowledge that we want to share with you, is we want to make you aware that the markets are highly manipulated, that you really, by all means, pay attention to what the media is saying, but the media is used to move the dial between greed and fear, euphoria and panic, complacency and hysteria. There's a dial that moves. We have to know that may be going on in the background, but it's what's happening on the charts that will ultimately guide whether we should be thinking of buying and selling. And that comes down to price action, to volume, the VPA methodology, and also those all-important support and resistance levels. For the Qs and the NASDAQ, the high was in March 2000. That was 120, but it actually took the index 17 years to regain this level. So what we can do to give us a sort of an insight at the moment of these three, what is happening with those three sectors, is we can go to the sector charts, the individual sector charts, because if we accept, and we have to accept, the distortions caused by market cap indices and ETFs, when we pull up the sector charts for tech, what's interesting is we see a similar chart pattern to what we have seen on the SPY and obviously on the S&P 500. And what's interesting is it's already at this all-time high, and it's actually slightly pulling back. So is this telling us, what is this signaling? Is it a red flag that we should pay attention to? Maybe, but certainly if it goes through, it would certainly give us confidence that the ETF and the index is likely to go higher as well. Communication services have not been, sectors not been around so long. Sectors are created all the time by the companies that produce ETFs. It's a great way for them to make money. And here, so some of them, the data doesn't go back that far. Now, what's interesting here is we have a classic VPA anomaly where we have seen the sector move higher, but the volume going in the opposite direction. Is this telling us something, particularly when we, read it in conjunction with what we see on the tech sector chart? And finally, we look at the consumer discretionary chart. What do we see here? Well, don't forget consumer discretionary. Yes, it has those all-important companies which could also fall under the umbrella of tech, i.e. Amazon and Tesla. That is kind of holding up. The volume is going in. It's not extreme, but it's a little bit more measured, if you like. But it is some way off that all-important all-time January high. Bit of a mixed picture, but nevertheless, we just have to keep a watch of what is going on. To return to the SPY we have here, and I'll have a look at the Qs as well. And we want to look the up-to-date one. We don't want the old one. That one. That's it. Where we are at the moment. And just to recap in terms of trends, primary trends and secondary trends. As I said, if we take this as a primary trend, or we could even argue it goes back even further, this is a massively long trend with corrections. There's a deeper correction, but the primary trend has been intact. I think this makes it the longest bull market in history, as it were. We could say the current rally is an attempt to resume that primary trend, but as I said earlier, there is a caveat to that. To be validated, it has to take out this high, and certainly if it did, well, who knows where it goes on after that. But a failure, we would see a double top. We may even see a distribution phase develop with congestion and a dramatic reversal. And to the downside, what is the key level? Well, certainly this level here that was formed by the ascending triangle at 417, 418, and a much deeper reversal or correction would be this October 22 low. Secondly, the stocks that are currently propping up the markets. This is just an additional information for you to be aware of and to consider. They attract huge option flows, particularly calls. So the option dealers and market makers, they have to deal with this flow. I mean, it is disproportionately calls, and that often results in them having to purchase the underlying asset when they have to manage the various Greeks, that's the gamma and delta, and that adds further bullish pressure. The option market is such a huge market compared to what it was when David and I started. We've actually said that it's almost come to a point where it's the tail wagging the dog, and it's a reason why we have put a dedicated module, a module dedicated to options in our stock trading and investing program, which, fingers crossed, all being well, we hope to launch in the next 2 to 3 weeks. Because if you are not aware of what is happening in the option market, particularly with these stocks that are driving this market, and it's and as I said, it's the Nvidia, it's the Meta, it's the Amazon, it's the Microsoft. We see where those 10 stop at FinViz. You are really going to be handicapped in really understanding what is happening in the market. What's also happened is the volatility has not disappeared completely, but it's been squashed, and that leads to complacency. And when markets are complacent, when volatility, the VIX is low relative to its mean, which is about 20. So when it starts to approach single figures, I think today it's about 13, and certainly if it gets into single figures, we know the market is hugely complacent. But what that also does, it triggers the passive investing algos. They are set up in such a way that they read the volatility, the various volatility indices, and this correlation that we have between volatility indices and the indices themselves. It's the only example of where there is a direction to volatility, because volatility is non-directional, but the VIX is low. We can expect the S&P 500 to move higher. These algos are it's a mechanical bid. That's what they're programmed to do. That's going to put more pressure on equities. We have stock buyback programs. They, I believe, can account for up to 850 billion per year. Now, I appreciate that is across the market, but that's another, if you like, positive for the market in general. So you have this wall of money pushing up the market, and traders and investors, they see the stock prices going up, they're more bullish. Despite what they may be reading in and hearing in the media, they become more bullish, and it leads to a self-reinforcing feedback loop. Or, as we can say, buying begets buying. On the opposite side, when we have a bear market, selling begets selling. Against all this, we cannot forget the Federal Reserve. Their constant talk about higher interest rates. Higher interest rates is going to be longer than we expected. We've got to take inflation out, full stop, even if it means there may be a recession. But don't worry, it's only going to be a mild one. For the time being, the market is kind of ignoring them. I know we've had some reaction to the labour market stats. We had a very good ADP figure come out yesterday, and the NFP came out today. The figures didn't quite meet expectation, but they're still pretty healthy. And the employment rate has gone down. So you have a strong labour market. If you've got rising inflation, workers are going to demand more money because there is a cost of living crisis, or certainly is here in the UK, and it's the same in the US and the world over. So you have all this battling in the background at the moment, and maybe that is what will almost, I went to say, bring this market to its senses, but maybe be the trigger that will say, hey, this is going up on 10 stocks. This is not sustainable. It's been sustained up until now because earnings have come in not as bad as everyone thought. There's all this boiling underneath, the sort of maelstrom that's underneath, and it's waiting to explode, as it were. Where you'll see this is in the bond market, and it's the one market that no one can afford to ignore, because as interest rates go up, yields go up, and there you do get this inflection point where rising yields, certainly on the shorter term treasuries, go up and up and up, and people look at the short term yields, and it's almost is a guaranteed return. They say, well, hey, I can get nearly 6% on a 3-month treasury. I'm going to take my money and I'm going to pile it, because I'm really not sure. Maybe all this talk in the background about increasing interest rates, market is going to wake up, as it were, to the dangers that lie ahead. I'm going to take my money, take my profit. Well, certainly if you've been in Nvidia and you've made whatever return this is since October or since the beginning of the year, I'm going to take some of that money and I'm going to put it into bonds, and that will then percolate through, and as more money goes in, the yields, sometimes it does depress the yields, but on a fixed 3-month bond, that is what you are going to get. So the bond market is certainly something to watch, and as someone once said to David and I, there is truth in bonds. In summary then, whilst last year's drop beyond the 20% does fall into this definition of a bear market, that move lower was driven by the 3 sectors that we've looked at, and which are now driving the market in the opposite direction. And this is only possible by virtue of their outsized influence on an index that has been constructed using market cap. The current reversal has the potential, this bear market rally in inverted commas, has the potential to continue, at least to test the all-time highs for the, as I said, for the indices and the ETFs. And if and when it gets there, we can certainly look at it again and revisit the price action, and certainly always the volume. It may not get there. Something may happen which will throw a spanner in the works, as it were. But at least you know what to look out for. You know the levels. You've seen what's happened in the past. And by all means, if you have the opportunity to go and look at other periods in history, as it were, stock market history, and see, what kind of patterns we have there, because patterns do repeat. Be aware of the broader factors, including what is happening in Ukraine. And at the end of the day, just watch your charts, watch the price action, watch the volume. You know where the key support and resistance levels are. Look at the sector charts, see what is happening there, because the tech sector chart is certainly already touching that all-time high. That will give you a much rounder, a more complete picture of what is actually happening at the moment. And just as a little aside, I've been talking about this at 20% level. This is the standard definition that's been taken up. There's a very interesting story behind it. I won't deal with it now. It's something I'd like to do at on a later video, because it is a totally arbitrary number. They could have taken 15%, they could have taken 25%. And there are some old school traders and investors out there who absolutely rail against the 20s. It's absolute rubbish, they say. It's totally meaningless. Whether it's meaningless or not, personally, I'm in agreement with that. But it's what the market believes, and ultimately that is what you have to take account of when you are looking at the chart. If it falls 20 and it carries on and it carries on, just trade and invest what you see on the chart using price action, volume, and those all important support and resistance. I hope that has helped. I hope that answers that statement, or at least clarifies that statement. July is certainly going to be interesting, and I think the summer is going to be interesting as well. The summer is when markets tend to quieten down, but we say that every year, and then something happens, and it's certainly going to be a fascinating and interesting second half this trading year. So thank you for watching. I hope you've enjoyed it. If you want to send me a question or want to leave a comment, then please do so via my Twitter feed, my email. I've normally give my email address out, but my inbox is playing up, and sometimes the emails just don't get through, but you can always catch me on Twitter. So thank you again. It's Friday. The session is almost over. I hope you've had a great trading day. I hope you've had a great trading week. Have a lovely weekend, and I will catch up with you all on Twitter next week.